As a value investing channel, we really love Berkshire Hathaway, Warren Buffett, Charlie Munger. Warren Buffett owns Kroger, Paul. We get a lot of requests in the Bid and Ask Nation, if people are our Patreon tier, about with Mo, who's not here today, about trading Kroger. It's a supermarket chain. There's a lot of buzz about this, Paul. I want to look at, as we always do, look at the 8 pillars behind this company. The ticker price is $46. We frankly don't care what it's cost. We want to look at the revenue, the profit, all the 8 pillars we do to analyze a company. And I'd love for the seer Paul Gabriel to go into it right now.
We do care what the stock price is, but we don't care that until the very end when we determine a value for the business and divide it by number of shares. Right?
That's true.
And just as brilliant as that was.
That wasn't that. Yeah, go on.
I would like you to brilliantly open your Instagram and follow us on Instagram so I can get my blue check mark. How's that brilliant? I have no idea.
Can we move on?
Guys, Kroger, 2,742 supermarkets. This is incredible. Berkshire owns it. $35 billion market cap. The 5-year PE is 16.5. We want it less than 22.5, so that's a check mark. What this is, it's taking the current market cap divided by 5-year average earnings, okay? So it's definitely below where we want it to be. Profit margin is low. Don't be worried about that one. Grocery stores are always low. 5-year return on invested capital, though, 4.7%.
We would like this over 9, Paul.
Yeah, and it concerns me because they're a business that has to grow, and so they're telling me we haven't really made a great return on our invested capital. That's over 5 years. Last year was very good, but they probably had a pillar year last year because of the shutdown, right? Dividend yield. So far, that's an X, and we have 1 check. Dividend yield is 1.5%. It pays out $534 million.
Do they have the free cash to pay said dividend, Paul?
5-year average, $1.57 billion. So they literally only pay out a third of their 5-year average free cash flow in dividends. So that's awesome.
Revenue growth over the past 5 years is the next metric we use, Paul.
117 to 132. Big key here, guys. How much of this is same store versus growing the number of stores out there, right? Whenever it comes to any sort of retail location and a company that's growing its retail locations, you need to make sure that the existing retail locations that have been around for 12 or 18 months or longer are growing their sales naturally. Because anybody can show revenue growth top line just by opening a ton. If they open 10,000 more stores, even if they all do half the revenue, they're still going to show higher operating revenue. But if they're not doing it efficiently, you don't want that. So still a check mark though.
How about profit growth over the past 5 years?
1.58 to 1.51. That's an X.
Oh boy.
Yeah, it's kind of all over the board, but we'll see. That's why with companies like this, when it's all over the board, you want to look at long-term averages, which is why I like the 5-year PE.
Paul, I was perusing through the 10K, which you can get as a part of our software if you want to join our Patreon right now. If you join Patreon, you get access to the software, you get the Discord community, and everything else Paul's going to talk about right now.
You get everything on this page, guys. You get the mobile app, 8 pillars, 30 years of financial data, all the way down to our Discord community with over 5,000 people you can talk to about your investment ideas. You get it all for 84 cents a day, less than a crappy cup of coffee at Kroger, versus $200 a month, $200 a month, and $35 a month. And you get everything here. It's a no-brainer. We created the software because our users said, our subscribers literally kept asking, where do I get the software from? So we said, we'll just make it. So what'd you find in the 10K?
A bunch of crazy numbers all over the place. I'm trying to find how many stores they're opening up.
Look at just search for new stores.
Thanks.
While you're doing that, I want to show you one of our metrics. Shares outstanding, guys. They went from 914 down to 752. That's a pretty big drop. So they're buying back shares, which is great, which is probably a nice reason why Warren Buffett likes them so much. Now, for our new 6th pillar, what we're looking at is total long-term debt. Total long-term liabilities of $24.4 billion. We want that their free cash flow over the last 5-year average is less than 5 times. The total long-term liability is less than 5 times their average free cash for the last 5 years. Their average free cash flow for the last 5 years is 1.57. So therefore, I'm sorry, that is an X. That's 24 divided by 1.57 is roughly 16. So it's roughly 15 or 16. It's a little too much, but that can involve a lot of leases that are in there so you have to make sure that I wouldn't be as turned off by that because they probably have a lot of leases that are capitalized in there as opposed to operating leases. So don't be as upset about that one for retail. Now, average free cash flow from 573 to 3.95. Now, here's the deal, guys. You had to discount this 3.95. That was a fluke year. I don't think you can, but either way, 1.57 times 20 is $31.4 billion. What's the current market cap?
35.
So it's not far off. It's still an X there, but I'm being very cautious because this last year was a fluke. Just like other companies that have, like Carnival Cruise Line that had flukes last year, you can't take those into consideration. You got to discount this. I would operate more at 1 billion times free cash flow. So I'd want to pay about $20 billion for this company on the high side based on that multiple. But what we're going to do next is we're going to look at the stock analyzer tool to determine what we should pay for the company today. Seth, did you find anything on the new stores?
No, I can't find the stores. I mean, again, folks, would
you like me to look?
Go ahead. I mean, Paul, you can fire up the 10K and see it. There's a lot of, there's just so much data here. If you really want to do the due diligence on this puppy, go for it. That's really not our channel, Paul. You've doubled down on this a lot. We're using our 8 pillars as an initial screener. There's thousands and thousands of companies. Just because Berkshire owns this or Warren Buffett loves it doesn't mean we do. So we'll start doing our own due diligence. And so, but that's not really, we're not here to bring you the news. So if you want to dive deep in this, look at all this stuff, you can. But Paul, this is good. This is crazy. Look at all these numbers.
There is a lot. So we want to sit here. And so let's go to stores. Let's type in stores.
So they do have over 2,700 stores, which was more than I thought. I mean, that's a good number here.
All right, guys. So in the 10K here, we found page 33 has their number of locations. So in 2018, they had 2,782. They actually, guys, if you look at this, in terms of beginning of the year versus end of the year, they finished with 2,764. They actually have less locations than they did in 2018. So revenue's up with less locations. That is wonderful, okay? Total supermarket square footage, about the same. Now, one thing I also want to point out that I found here, one of our metrics is return on invested capital. If you Google this, you're going to get 80 different ways in which to calculate return on invested capital. A lot of companies will disclose it and how they calculate it down below. The very next page, the way they calculate their return on invested capital, it's a lot more complicated than mine. They have it at 12.87 and 11.19. We had it at 4.5. You might sit there and say, wait a second, that's very different. It is very different. Ours was 5 years. This is 1 year. Our 1 year return on invested capital was much higher. It was 11. Our 1 year return on invested capital was 11.9%. So much more in line with their 1 year return on invested capital, right?
Yeah.
Much more in line. So keep that in mind when you're looking at the 5 year return on invested capital. It's a much more conservative number, but it shows that they can make more money over long periods of time. So I'm very impressed with that. We're going to go to the stock analyzer tool right now and figure out what we're actually willing to pay for the company, because I really like the fact that they've decreased the number of stores they have and still increased their revenue.
This is the final piece of the puzzle, is we take all these evaluations of fundamentals and determine what do we pay for Kroger. So as we said before, we don't look at the stock price right off the bat. It is $46. Is this a deal? Is this a screaming deal? Is this overpriced? The stock analyzer tool you can get as being a patron can help you tell that with some assumptions that Paul is putting in right now, Paul.
So I'm going to put in, I think 12, 13, 15, 12, 13, 15, 15, 12 and a half, and 10%. So we're hitting the analyze button. It's at $47 a share as of this very second. I put in 2, 3, and 4%. Remember, guys, I'm going conservative because my goal as a value investor is to look at 10,000 companies and pick 20 or 30 that work based on conservative assumptions, right? So the way I'm looking at this, and probably the way Warren Buffett is, which is why they like it, even though my highest assumption was 4% on revenue growth, which is very high, they are pretty much doing that. And the price at the highest assumptions looks pretty attractive, especially with that return on invested capital on a year-to-year basis. If they can continue that going forward, they're going to do quite well. For me personally, I still want to buy it lower. And the reason being is last year was a big, huge year. I feel like people are going to exaggerate that completely. Very low margins. 1.5% is a high margin for Kroger. I just look at that saying, I still feel comfortable for myself owning this grocery store. And you might sit there and say, that's a big drop. It's not, guys. 47 to 35, that could happen very quickly. So keep this as part of your look. I don't know when Warren Buffett bought it. It could have been a lot lower when Warren Buffett bought it.
Yeah.
But I'm just sitting there. I would be more cautious about how I feel about it.
Yeah, I don't know if the branding is there with Kroger. Giant Eagles switched to this market district, and I think the branding with like the organic.
I love Kroger.
Oh, do you?
Yeah, I do.
But I mean, if you walk into a Whole Foods, you're going to get a different experience. Sprouts Farmers is also in
well,
the
I think
South.
those are trying to appeal to a different market too.
Yeah. Well,
don't you think?
Can Kroger get into that? I don't know.
I don't know, but I don't think they're trying to.
Oh, okay.
Yeah, I don't think Kroger's trying to be this high-end grocer. Do you?
When you put a Starbucks in there, it gets pretty awesome. But I mean, like when Giant Eagle switched to when Giant Eagle switched to normal Giant Eagle to like Marketplace, and you have like the
Market
fresh,
District?
Yeah, they got the fresh cooked food, and they got a wine cellar and stuff. I mean, it's a little much more appealing.
First off, you said Giant Eagle. There are probably 14 people watching this video who even know what a Giant Eagle is.
That's true, yeah.
They're in Ohio and Pennsylvania.
Uh-huh.
Is that pretty much it? Yeah. By the way, there's more than 14 people because we just had 100,000 people hit our views in the last 2 days. So,
nice.
Dab.
That is our take on Kroger.
So I'm just holding off on Kroger. I looked at, by the way, the operating leases. They have a lot of leases that are finance leases, which go on as long-term debt versus the operating leases. So I would not worry about the long-term liabilities as much as other companies.
That's a take. Tickle the thumbs up on the way out, and as you tickle Paul's belly at Kroger while he's shopping with you got the cart, and you go around, you get the cereal you love.
Yes.
You don't cook for yourself at all, right?
I don't cook.
Yeah, I mean, yeah.
I go to the grocery store though because somebody's got to buy my drumsticks. Drumsticks are fire. By the way, I say drumsticks, I mean the ice cream drumsticks.
No doubt, baby. That's our take on Kroger. Fondle thumbs
ones
up.
with the mint chocolate chip on the inside.
Oh, you get mint in those too?
Yeah, they're incredible. We'll get to
Patrons, I love you. Good seeing you. See you next video.